Did you know that real estate has outperformed the stock market over the past 50 years, delivering an average annual return of around 10%? That's because capital gains, when your property appreciates in value, can supercharge your investments. Welcome back to our real estate investment series. In episode 1, we broke down ROI on rental income. Today, we're shifting focus to capital gains, the profit you make when your property's value increases over time. Understanding capital gains is essential because while rental income keeps your cash flow steady, capital gains build your wealth more rapidly. Investors often face several challenges when evaluating capital gains. How do you accurately calculate the appreciation of your property after accounting for taxes? What impact does investing in a furnished rental have on your overall returns? Remember, if you buy a property to rent it out furnished, the cost of the furniture is a capital expense that depreciates over time, unlike when you buy a home solely for personal use. And how do property types, unfurnished, partly furnished, fully furnished for long-term or short-term rentals, affect your ROI? Additionally, market trends, tax implications, and location-specific factors add layers of complexity. For instance, buying in an up-and-coming area might yield significant capital gains, but there are risks like market uncertainty, infrastructure issues, or overcrowding to consider. Let's break down the calculation for capital gains. Remember, most countries impose a capital gains tax on the profit you make. The formula is as follows. Capital gains ROI equals, open parenthesis, final sale price minus initial purchase price minus capital gains tax, divided by initial purchase price, close parenthesis, multiplied by 100%. For example, if you buy a unit for $200,000 and sell it for $300,000, the raw capital gain of $100,000. However, if the government charges a 20% capital gains tax, you must subtract $20,000 from your gain, resulting in a net capital gain of $80,000. In this case, your adjusted capital gains ROI is calculated as $80,000 divided by $200,000 multiplied by 100%, which comes to 40%. Also, if you're operating a furnished rental, the cost of quality furnishings, while a capital expense, depreciates over time and must be included in your overall calculations, unlike if you're simply buying a home for personal use. Another powerful tool is the Rule of 72, which estimates how many years it will take for your investment to double, assuming a steady, linear annual return. The rule is stated as years to double equals 72 divided by annual ROI. For instance, if your capital gains ROI is 10%, dividing 72 by 10 suggests it will take about 7.2 years to double your investment. With an 8% ROI, it's roughly 9 years. However, be aware that property appreciation isn't always linear. A property might appreciate 10% in the first year, but 20% in the second. So this is a simplified estimate. Other examples include a 5% ROI, which gives you about 14.4 years, and a 12% ROI, which suggests only 6 years to double. To grow your real estate portfolio quickly, focus on maximizing capital gains by getting in early on promising opportunities. Consider these strategies. Raw land purchases. Buying land in areas where new roads, malls, or business centers are planned. Off-plan unit investments. Purchasing properties before construction begins to lock in a lower price. Investing in up-and-coming neighborhoods. Target areas that are beginning to see development, where a surge in demand is anticipated. Pre-development opportunities. Acquiring properties or units in anticipation of future development that can drive up value quickly. Each strategy has its risks. For example, purchasing raw land or off-plan units might feel like gambling if the expected development never materializes. Also, factors such as market crowding or poor infrastructure, like insufficient roads or public transport, can slow down property appreciation, even in areas with development surges. Here's the key insight. To truly understand your property's performance, you must combine both your rental income and capital gains into one comprehensive ROI calculation. Start with your total capital investment, which includes the purchase price plus any capital spent on furnishings for rental units and any replacement costs incurred during the period. Next, determine your net operating income, or NOI, by subtracting all operating expenses from your annual rental income. Then, evaluate your capital appreciation by comparing the current market value of your property to your initial purchase price. We calculate the comprehensive ROI by saying, comprehensive ROI equals, open parenthesis, market value minus initial investment plus net operating income, divided by initial investment, close parenthesis, multiplied by 100%. For example, imagine you purchased a property for $200,000 and its market value rises to $300,000, yielding a raw capital appreciation of $100,000. If the property generates an NOI of $14,400 per year, your combined return is calculated as follows. Add $100,000 and $14,400, divide that sum by $200,000, and then multiply by 100%. That gives you an overall ROI of approximately 57.2%. Now, if you decide to realize your gains by selling and are subject to a 20% capital gains tax on the $100,000 gain, you would subtract $20,000 from the gain. This adjusts the capital appreciation to $80,000, and your comprehensive or adjusted ROI becomes adjusted ROI equals, open parenthesis, net capital appreciation plus net operating income, divided by initial investment, close parenthesis, multiplied by 100%. In this case, 80,000 plus 14,400 divided by 200,000 multiplied by 100% comes to approximately 47.2%. This comprehensive formula gives you a full picture of your property's performance, capturing both steady rental income and the potential for rapid capital appreciation. To recap, capital gains are a key driver for rapid portfolio growth. By accurately calculating your capital gains, factoring in capital gains tax, and including expenses like furniture and rental units, you can make better-informed investment decisions. Using tools like the Rule of 72 gives you a rough timeline for doubling your investment. But remember, real-world returns can be non-linear. And when you combine your rental income with your capital gains, you get a true picture of your property's performance. Have you faced challenges evaluating capital gains or balancing rental income with property appreciation? Let us know in the comments below. And if you found these insights helpful, hit like, subscribe, and ring the bell for more real estate investing strategies. Stay tuned for our final episode on low capital strategies to break into the market.